And as you've been hearing us say all day, the Fed's favorite inflation gauge coming in as expected. Bond yields slightly higher following those numbers. Let's get to Chicago for more bond market reaction. Rick Santelli standing by. Rick, over to you.
Yes, and you know what? Keep an eye on that 2-10 spread. It's getting ever closer to zero, and most likely it's going to start steepening. Jim Bianco is my guest today. Jim, real quickly, what do you think of the PCE numbers today?
They came in as expected. You know, that there wasn't really much of a story to talk about at 0.2 and 2.6. So that's why the market had very little move on it afterwards.
Am I wrong to think that we're probably not going to really ever see 2%? 2.5 to 3 is probably the marching orders that we're going to get from the market response back towards the Fed, but it's probably still not going to be the main issue they use to pull the trigger on the easing.
I agree. I think that inflation is going to be the big story. I think it's going to stay sticky around 3% as well. That last mile that they keep talking about.
And if they ease a quarter point and it starts to pop up even just a little bit, they're going to have some issues there.
Yeah, exactly. You know, you cut rates, and if the data doesn't go the way you think, in other words, it's too strong or inflation pops up, there could be a bad reaction in markets.
Absolutely. Now let's talk about the big elephant in the room, and you've been writing extensively about this. You know, we had that big revision in on-farm payrolls. It was, what, 850,000?
818.
818, and ultimately many think it should have been much lower. What's going on, and how does that tie in with immigration?
The population of the country has been exploding higher because of immigration. All of these surveys, there's some basis, the level of population growth. And that's what's throwing off both the household survey, the unemployment survey, and the revisions. The revisions look at tax data, which is basically not immigrants, and they came to the conclusion we had 818,000 less jobs, but it might have actually been 300,000 less jobs. 500,000 people took jobs that people under the table, that people used to have that were paying taxes.
Now, when I siphon through all this, here's what I think. I think seasonality is already not very good in these numbers, and it's getting worse. COVID changed so many things, A. B, certain states, I just don't trust their numbers, and B, nobody knows how many migrants or immigrants are coming across that border, so I don't know how they could divine some of these numbers. Would you agree with that?
Yes, and the reason I would agree with it is we talk about the labor market, we think we're counting jobs. We're doing surveys. We're asking people how many they employ. We're making assumptions, and then we weight those assumptions by the changing population growth of the country. That's why the unemployment rate's going up. That's why the household survey is stagnated relative to the payroll survey, which keeps going up. And a lot of the data is throwing us askew. And we all look at it and say, oh, the labor market's weakening. It might not be weakening. Maybe more people have jobs. They have more money. That's why consumption's up. And that's why inflation could stay sticky.
So what you're really saying is if basically the worst aspect of the labor market, what is the banner, poster child of the weakening, is the rise in the unemployment rate, that might be the riskiest aspect of that report to basically bet the ranch on.
I agree. And none other than Claudia Sahm with the Sahm rule has said, be careful because of the increased labor supply.
Right. She said she doesn't know if it's going to work this time around.
Where is that increased labor supply coming from? It's coming from immigration. And so this data was never just structured to fit with an exploding population growth like we have now, and that's what the problem is.
Real quick, we're almost out of time. If the jobs report next week shows that the unemployment rate holds or drops a little bit, will that make any difference on September 18th ease?
Only to the extent that the Fed would go 25 instead of 50. 50 has still got about a 35% chance of them going.
Excellent. Jim Bianco, it's always a pleasure. We love to do floor hits together. Deirdre, back to you, and have a wonderful 3-day weekend.
Rick, same to you, both of you. Thank you so much for that. Still to come, Intel going